Podcast is now starting. All attendees are in listen-only mode.
Hello, everybody. Welcome to Bursa Malaysia Derivative, the third webinar series on understanding KLCI futures. All right, today we are very honored to have invited somebody really renowned in trading futures market in Bursa Malaysia. His name is CC Yong, which I'll introduce later. But once again, I want to thank everybody for paying attention and joining our webinar, the third series of our webinar called Understanding KLCI Futures. Now today we're going to share with you how you can take advantage of the futures characteristic where you can long the market and as well as shorting the market as well. Now usually during the bear market, you may not know what you need to do, how you can profit from bear market, but through FKLI, you have an opportunity of how to make a profit during the bear market, right? And today we are going to explore how exactly you can do that and some strategies on how you can do that, right? And this webinar series is brought to you by Bursa Malaysia Derivative. And before I proceed further, just want to check if you can hear me clearly. So you on the right hand side of your screen, you should have a control panel. So if you hover your mouse over to the control panel, and if you can hear me clearly, can you please click raise the hand button? Okay, can you please click raise the hand button? Okay, cool. I think many of you can hear me. All right, awesome. You can put down your hands now. All right, so this is Shane. I'm the moderator for today, and on the one side of the screen is CC, the speaker, CC Yong. Can you please say hi to everybody?
Hi everyone.
Yeah, thank you so much for joining our webinar tonight. So yeah, but we are doing this live because I want to save the bandwidth so that we can have a smoother internet connectivity. I'm going to switch off my webcam if you allow. All right, so I'm going to switch off my webcam now so that everybody can have a smoother internet connectivity. Okay, so all right, so this series is brought to you by Bursa Malaysia Derivative, and of course, first thing first, a disclaimer. Now, whatever we share in this webinar is only for educational purpose only, right? It doesn't, the speaker nor Bursa Malaysia Derivative give any buy or short or any long or short position in any of the contract. So if you decide to do any financial decisions, you do it at your own risk, okay? And you are entirely financially responsible for your own financial well-being. Of course, if you make money, you don't have to credit us, okay? Well, because we just want to help you to gain a better understanding about futures on Bursa Malaysia. All right, and this webinar series is brought, we have structured a series of webinar from the first one, basic of derivative, until getting started in futures. Today, we are on the third one, understanding KLCI futures, and also a futures trading plan, risk management for futures, and futures analysis. All right, so if you want to, as long as you join us in all our 6 webinars, you should be fairly knowledgeable about how to get started in trading futures and make your first investment or trading in the futures. Okay, now let me introduce our speaker today. Now today our session is about 90 minutes long, but we will try to finish it before 90 minutes so that we can have more time for the question and answer sessions. All right, the speaker today is a renowned full-time futures trader. His full-time job is in trading the futures market, and he's also a local participant of Bursa Malaysia Derivative. If you later he can explain to you what is local participant. If you have a status of local participant, which means that you're really a high volume traders on the derivative market, right? He's also a founder of Straits Index Sdn Bhd, a proprietary trading company and associate participant of Bursa Malaysia Derivative. He's a trader, and also a writer, and he has been engaged as a speaker for SIDC, several programs at SIDC and various financial institutions, and he's also a columnist for several media and financial magazines for more than 10 years. Right, so without further ado, let me hand it over to CC. All right, I'm giving you the control now, and then you're a presenter, okay?
Okay. Hi everyone. I hope everyone can see my screen. Thank you, Trishan.
Yeah, I'm seeing it right now. Your screen. Awesome. Yeah, good.
Okay. 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 Well, This FKLI is we call equity futures index. So equity, as you know, is actually stock markets. So we have actually some equity derivatives in Bursa, which we'll focus on FKLI today. And then we also have the options contracts as well as the single stock futures. All right, I will actually really talk about the FKLI first, and then with the most important part, the underlying asset, which is the Bursa Malaysia KLCI. So we call this FBM KLCI in the abbreviation. It's actually this KLCI index is actually represents the top 30 capital companies in Bursa Malaysia, the stock market. So this is a headline, so which we call benchmark index for Bursa Malaysia. They have a series index. So this is the first or the most important part, which represents top 30 companies in Malaysia. So this is like, if you know, Dow Jones Industrial Average, which they also comprises 30 top companies from US. So the objective of this index is to design, to use certain, for your creation of index tracking funds, or to trading the futures, and also is a performance benchmark for the whole stock market. And it's also investability, which means the stock is actually, they are selected and weighted to ensure that the index is actually pretty much investable. So here, the term we have to look at is actually the derivatives and also investable. So talk about investable, so we talk about capital return. So capital return and their volatility, this is according to the source. Okay, over the 5 years from 2010 to 2015, the overall return is actually more than, in 5 years, it's more than 10%. So that means that if you actually invest in this FBM KLCI or the top 30 stocks by the market cap, you will actually have the positive return. But to buy 30 stocks with the correct ratio, you have to do a lot of calculation and monitor many stocks, which at least 30, and invest, okay, buying the stock one by one. But if you're investing in this FKLI, you will have the same return from this formula, but only you have one instrument or contract to be monitored. So that's why it's actually investable from what I mentioned just now. Here are the top 10 stocks from this FBM KLCI, and it's always ranked by the market capitalization. So as you can see here, the biggest company by market cap will be the bank sector, which will have public bank, Malaysian banking, Tenaga, and so on and so forth. So you actually, when you trading or you buying an FKLI, okay, you're owning a contract of FKLI, you actually virtually are owning these stocks by the ratio shown on the screen now, right? And then the FKLI is actually created with the FBM KLCI, which is the cash index as an underlying asset. Okay, so what means is the FBM KLCI, we usually call this is the stock market, okay, or sometimes we refer this KLCI as cash market, because futures, that means you are trading with the futures, but the cash market or stock markets are something that almost like we call a tangible cash market. So that's why the term we call usually refer as a cash or stocks market. And in FKLI, actually, it actually tracks, okay, the FBM KLCI or simply KLCI for the final settlement. What is final settlement? That means every month the price of FBM FKLI will be tracked, okay, to the cash market, which is KLCI, for the final price, or we call settlement price. And this means the FKLI will have to close the gap, okay, if any gap, that means the price of FKLI during any point of time, they can be above or actually below the tracking index, which is the cash market index KLCI. It can be higher or lower, but then before or during or when the expirations, the FKLI usually will close the gap. Usually, okay, we close the gap because there's a formula I will explain to you in a bit later. Okay, in this slide, you can see that the cash market, which is the KLCI, all right. Let's say, for example, it go up and down, for the duration of 1 month. The FKLI, it can move below or above the KLCI or cash market, but by end of the month, during the settlement, the price should be actually tracking to the cash market. So that's how you actually create an index, or we call the FKLI, to track underlying index or asset. So by actually forcing the settlement at certain price or level. So that's why the FKLI actually is created for this purpose. And in other words, when it's tracking, the tracks of the movement of the underlying assets, which is the KLCI. So that is how you make this FKLI become investment or investable, to become an asset. So the FKLI is actually created. You can buy and sell FKLI contracts, which carries the value of underlying asset, which is the cash market of the top 30 companies by market capitalization. Now, in short, this FKLI is actually a contract. Contract is like when you buy something, you sign a contract. All right. So this contract, if there's a contract in futures market, it has an expiration date. Okay, if you want to hold a contract beyond the expiration, so when is the expiration? The expiration will be the time that this contract expires. Usually, FKLI is actually expires at the end of the month, the last day of the month. So if it's expired, if you want to keep this contract, you have to do something. Technically, we call rollover. Means, let's say, for example, now, let's say last month you actually buy or bought or sold a contract of September. At the last day of September, you have to, dispose your September contract and then to roll over to the next contract, which is October. So if you buy a contract in September, you sell it September, and then you buy so-called October contract. So you can carry on from 1 month to the other. By doing that, you actually we call roll over. So that is one of the things that you can do in FKLI. Unlike stocks does not has expiration date, which you buy a stocks, not warrants, not call warrants, and all that. If you buy a stock, as long as the company is in business and listed in the Bursa Malaysia, all right, you can hold it almost like forever, and they pay still the dividends. But to hold a contract of futures, you need to actually be aware of the expiration date, which if the contract expires, you actually, not to say force liquidate, but you will be going into a process called settlement. So they will actually either pay you or they deduct you, your money if you lose money from this contract. So to buy or sell the 30 stock according to the specification, with a fraction of equivalent value, or we call cash value. This is what you do, is you to trade or to buy the stocks using a margin. So these are one of the things that you probably need to understand before you start trading FKLI. Okay, the following chart is actually a 1 month, actually 6 months contracts. The red line represents KLCI, which is the cash index, and FKLI. In the bracket is CC because every month you have to roll over, so that I just combine all the contracts together and then plot a line. So from here you can see that usually the red one is actually the cash market. Usually, FKLI price in such a way, it will actually tracks every end of the month. It will go back to the original. If it's higher, then it will actually come down and then meet the cash market. If it's actually lower, then it will come up and then meet the cash market price. So that's how the whole process, go on and on. So unlike index, you don't have to worry about the expiration. Futures, you have to worry about the so-called expiration. Okay, this is the two main thing, or the difference of FKLI and KLCI. So and then the next part will be the contract specification. every futures contract has got a specification that which usually you can actually download from the exchange. From here, I just briefly introduce you to the most important part, and I have a summary later on. So basically, it has an underlying instrument. The instrument is probably an asset I usually call it. And this is the asset is actually a composite index. Okay, it's actually just tracks it, but you can't track something without a value. So usually they will give you a contract size and value. So the contract size of this FKLI is the BM KLCI multiplied by 50 ringgit. So that means every point of the cash market it carries a value of 50 ringgit. So half point index point usually not usually, this is actually specified at 25. Previously, probably like more than 10 years ago, 1 point actually carries 100. So now it's actually 50 points, but then the minimum price fluctuation is actually half an index point. That's why the value is actually 25 ringgit. Now, there's a daily limit of the price can go up and down. So in here it's actually 20%. And contract months, okay. Contract months is how many contracts is available to be traded. Okay, for example, here you can see that the contract month is actually first we call a spot month, and the next month and the next 2 calendar quarterly months, which usually you have 4 contracts available for you to buy or sell or to invest or to trade. The spot month is the current month. For example, today is actually 5th of October, so the spot month will be October, and the next month will be November, and then the next 2 quarter month will be it's actually it's usually it's January, March, and then June, and then so on and so forth. So that's why you have the quarterly contract. For now, the quarterly contract will be on December, and the next one is actually March. So this is a 2 quarterly month available for you to trade. On the next slide, trading hours. What are the time that you can trade? Okay, it's actually quite similar to tracking or trading stocks. Okay, stocks market start at 9 a.m. okay, and pause at 12:30. But the FKI actually started 15 minutes before cash market starts. Okay, it's actually designed such a way you can prepare yourself before the cash market starts. It's actually an advantage. That means if you want to buy a stock, let's say for example, if you want to invest some stock, public bank or any stock that you wanted in the top 30, okay, because you have news or you have some thinker which last night look at the Dow Jones or look at Japan market, you think that the market can go up. So you, instead of buying the stock, the moment you buy a stock, maybe the stock jump like 5%, when the market open, you can actually start trading the FKLI 50 minutes before others are starting to trade the stock market. So you can actually buy FKLI first. Okay, if the price did go up, you can still buy the stock you wanted, because the difference of the price that you miss, you can actually gain back from FKLI, supposedly. Okay, so that is the idea why the market can, for the futures market, is actually allow you to head start 50 minutes. And then after the market close or pause, let's say 12:30 for stock market, you can actually still trading the FKLI, okay, for the next 50 minutes, because the market will pause at 12:45. 50 minutes after the cash market is still tradable. And the next session will be on 2:30 to 5:15. Again, you see, the stock market closed at 5, as you already know, but futures market for FKLI actually closed 15 minutes after cash market close. So you see, the time itself actually gives you some advantage, okay, on trading the stock market as well. Okay, next after this will be the final trading day. Okay, the final trading day is the last business day of the contract month. So you have to be careful when is the last day of the month. All right. So if there's a holiday, also you have to be 1 day earlier, And the final settlement. Okay, what is final settlement in this case is it called cash settlement based on the final settlement value. What is cash settle? All right. You can't actually deliver 30 stocks. okay, to you when your contract expire and you got deliver. Let's say you buy FKLI, you're supposed to receive the asset when the contract expire. If you sell FKLI, you're supposed to actually deliver the asset to someone who actually bought it. So what is the asset? The asset supposedly is FKLI or KLCI, but the index is actually tracking 30 stocks of the top 30 companies. So what you do, you buy the stock and then deliver to someone else? No, because it's too difficult to just buy a fraction of the stock. So in this case, they call cash settlement. Cash settlement means anything that you gain from this contract or you lose in this contract, you'll be settled by using cash. That means just money will do. If you, let's say, lose 1 point, 1 point is 50 ringgit, then you actually lost 50 in this case, or you actually make 1 point, which is 50 ringgit, or 1 tick is actually 25 ringgit, then you actually will deduct from your account. And okay, then the most important part will be what is the final settlement value. The settlement value actually is based on the cash market. You can see from here it's actually 3:45 and then to 4:45. These are the time that determine what is the final we call settlement value, okay, or on the last day, okay, of the KLCI traded. So once this value comes up, this is actually calculated automatically by Bursa Malaysia. So this value comes up, and this is the final settlement price, and everybody will honor this price and be settled at this price. Okay, that's when FKLI and KLCI close the gap. All right, so that's why but who determines the KLCI? The cash market or the KLCI is actually determined by the top 30 stock. Remember, so you can't really why they take that last hour and average and take up the highest and the lowest price. This is because not to allow someone actually to probably purposely to jack up or to push down the KLCI for their own favor or for whatever reason. So it can't be actually manipulated easily because they'll take out the highest and the lowest and average out everything. So the price that you get is almost where every stock actually closing at that price, and you get an average price, and this is the price settle, and this is the value worth by calculation from this formula. So you should actually, probably this is one of the fair method how this thing can be done to track FKLI to the underlying asset, which is the cash market. Right. Lastly, okay, is the position limits. All right, position limits is something that how many contracts you can hold for every month. So that means if you want to hold a contract, okay, you can only hold 10,000 contracts. Okay. Of course, if you buy one contract in, let's say, October, and you sell one, it's actually close your contract, so you actually own a zero. But you can actually buy 5,000, let's say, for example, buy 5,000 October, and you also can buy or sell 5,000 again for the November. So combined, you can have only 10,000. If you more than that, then you have to liquidate and maintain the 10,000 contract. This is also a sort of regulation to not to allow an individual to hold too much contract of this stock market, because FKLI is actually traded in margin. I'll discuss a bit in a little bit. So margin means you use a fraction, usually around 10% of the value of the asset, so that you can use 10% of the value and then trade this contract. It means the stocks is actually being margin, and you can use more than 10% leverage to trade the stocks. So to avoid any manipulations, so you have some limits in here. So that's pretty much on the contract specification. Let's I just sum up what I just discussed. Okay, usually there's a few points that you have to just memorize. Will be every single FKLI point, okay, or the KLCI point, which is very equivalent. They are actually 50 ringgit a point. But then the lowest position or the lowest picks is actually half a point or 0.5. So that means the minimum fluctuation of FKLI is 25 ringgit instead of 50. But 1 point is actually worth 50 ringgit. So in order to get the value or the contract value. Okay, the value of FKLI is actually the price of FKLI times 50 ringgit. So, for example, if let's say FKLI is actually now traded at 1,780 times 50 ringgit, the value of FKLI at this moment of time will be 89,000. So, because the minimum tick is half a point, okay, so if you multiply by half a point, so the minimum movement will be at 25 ringgit. Now, this is the final part. Margin actually to trade FKLI will be 4,000 ringgit. Okay, to control one contract. To control, we use the word control because you don't own, because you didn't pay the total sum of 89,000. You only pay about 4,000 to control 89,000, which is like 20 times of leverage. Okay, but although you actually pay only 4,000, but it doesn't mean that if you lose, because it's margin, you actually leverage, so you could actually lose more than 4,000. This is actually the risk, or this is the reason why a lot of people say that trading futures is actually risky. But my opinion is actually trading futures is actually, the risk is actually almost the same, if not lower. Okay, if you compare the stock market or cash market or any asset you're actually trading out there. So what is the actually the risk of actually trading these futures? Today I'm going to briefly talk about the risk and all this. I think I will have a detailed risk management seminar later in this year. But let's roughly we talk about what is the risk, or is it trading futures risky? So yes and no. Okay, if you don't know, of course it's very risky. If you try to, I'll share with you, this is my opinion. Okay, if you're trading stocks or you buy a stock, you buy anything, you're paying the stock in full asset value. What is full asset value? For example, if the stock price of ABC price at 89 cents, if you buy 100,000 shares, so what or how much you want to pay? So you need to pay, the cash of 89,000 in order to own this share, right? So that's how you trade stocks. So if this stock is trading at 89 cents, that's okay. But what if the stocks actually went half the price? So it went to 40 over cents, okay, 45 cents, let's say, for example. You actually lost half of your asset value, right? So you actually, your risk can be losing half also, or even more. Now, take a look on the future side. FKLI or futures, usually futures trade with margin or some leverage, okay? So let's say, for example, here, the FKLI value we hypothetically we say is at 1,780, okay? So times 50 ringgit will be 89,000 again, okay? So if you put up only 4,000 margin and using this 4,000 to control the asset of 89,000, so that means you actually control the 4,000, okay? With using 4,000 to control a very, very big asset. If you're buying a stock, you almost spend like 90,000 just to buy one stock, but you owning an FKLI futures contract, you only need to put up 4,000 only, okay? A very big leverage, okay? By using this 4,000 to contract at 9,000, okay, contract value. So if the FKLI actually go against you, that means if let's say you buy 1,780, okay, you buy this price, okay, but the price fell to 1,700, okay, you actually losing 80 points. 80 points, if you multiply by 50 ringgit, is actually 4,000 also. That means if FKLI against you 80 points, your margin will be wiped out. Okay, if FKLI against you more than 80 points, you actually lose more money than you put into your contract or account. So that's why most people will say that the futures is actually a very risky instrument. Actually, it's not. Actually, probably those or the person who trade or buy or sell the contract, they didn't really calculate the actual leverage or how many times you actually leverage your trading. In this case, 89,000, let's say, for example, divided by 4,000, which is 22 times leverage. That means you're trading with the multiplying of 22 times of your original money that you put in. So the money you can lose, afford to lose, is actually more than 4,000, but you assume you can only lose 4,000. So this is one of the major things that you probably don't want to mix up when you're trading futures. Okay. Now I'll give you some idea on the risk management, which is important before anyone start trading futures. So you must know the risk, which is very crucial. My trading is actually centered at how to control your risk. All right. My trading is never focused on how good you predict the next movement of the market. Okay, it's always on the risk management side. Now, margin is one of the risk side that you have to control. Is you control some big asset, okay, with a small amount of money. So if you don't know the leverage of potential risk, then it is very risky. But if you know, then it becomes actually less risky if you really know. So basically, the main risk is always over leverage, or in the more layman term will be over trade. So try to trade with a minimum leverage if possible. What's the minimum leverage? How to reduce your leverage? You have to actually design, or you have to come up with some idea how to reduce your leverage by, at the same time you reduce the risk as well. For example, instead of putting 4,000 to trade one contract of FKI, you could have been putting, let's say, 10,000, 20,000 to trade one contract of FKI. That is one of the methods how to reduce your risk. Now, all the risk is actually on the risk management side. I always say that risk control is the center of every successful trading story. You can hear a lot of stories, risk from books, some person, some reason they are trading really well in their business, and then how they do it actually. If they're successful in long term, usually one of the main thing that they can do it is actually by impose or by controlling the risk. They actually expose in every single trade. You have to actually control your risk in every single trade. It doesn't mean that today I have to control my risk, tomorrow I have a winning streak, so I don't have to control my risk. So it's never the case. It's every single trade that you trade, you should actually control your risk. So in simple terms, it's actually you trade with the money that you actually afford to lose. Of course, I'm trying to probably show it to you the FKI, the trading, all this. So, but the control risk part is always how to minimize, or if you can actually control how much money you will lose. That's the idea. Now, continue on the topic on FKLI. So, theoretically, FKLI is actually a benchmark index of our share market. Have you ever come across any decent market that the index went to zero? No, right? So, if FKLI theoretically should never go to zero, because our share market should always stay above zero. The KLCI shouldn't go zero because public bank has got so much asset, Maybank has got so much asset, TAB has got so much asset, so their share value shouldn't go to zero. Since the share value will never go to zero because of the asset, so KLCI should never go to zero. The cash market should not go to zero. The futures index that tracks this cash market, they shouldn't go to zero also, right? So this is the idea. Now, if you're actually using 90,000, for example, or even 45,000 to control one contract of FKI, which is almost like 100% of the value, or half the value of the cost cash market KLCI, to control or buy or sell one contract of FKI. So do you think that you have risk? Because since it never go to zero, so your 90,000 is always preserved. Then you can tell people that, oh, my futures, I will never lose more than the money that I put in, because there always are terms in any form you sign. Usually when you're opening a futures market, is that you could lose more money than you initially deposited. It means that the futures is actually trading with margin actually. But if you put in, we call full margin, which is 90,000, let's say for example the contract value, so you will never actually lose all the money put in, right? So in a way, you actually reverse the disclaimer. All right. So that's a part. And you need to, almost like lose 1,800 points, or for 90,000 or 900 points to wipe up the margin in this case. So that's why theoretically, if you control the risk by probably increase the margin that you put in, then you shall really never have the risk of we call risk of ruin. So have the account wipe out. So okay, enough probably on the sad part, which you could lose more money. Let's talk about the bright side. Stock market actually has a tendency to grow over time. This is actually from my observation, any benchmark index or decent market should actually grow over time. So for example, this US equity index, there was a report actually stating that it's actually the index itself outperformed 95.4% of mid-size or mid-cap funds. So over the last 15 years, that means no matter how hard a fund manager try, they could not actually perform better than the equity index. What it means? It means if you actually invest in the index, you actually outperform 95% of the fund managers in mid-cap size in US itself. So you could be a very good fund manager just by doing nothing, just buy the future index. So yeah, how this can be done? Well, because it has got a very big potential, but then part of the potential I just want to share with you is that part of that potential actually comes from something which you could be very familiar. We call inflation, because things or stuff the price got inflation over time. So because price inflation or your money or buying power inflation, so things that you're going to buy is actually getting more and more expensive, including the stock that in the index. So for that very reason, the stock market or the index itself will actually grow over time. So this is one of the reasons, but it's not all. I mean, this is one of the reasons. And then more and more value was created because let's say last time don't have Microsoft, you wouldn't have Apple, you don't have this high-tech company which create the wealth. They created a so-called wealth from something that we call technology. But technology last time it's never appeared in any stock market. Last time stock market is only gold miners, transportation company, all those tangible things. But nowadays Microsoft do hardly has any tangible asset, but most of the assets are in intellectual assets. So they created an extra wealth for the market. So that's why the index or the company or the share market, the share prices is grow over time as well. So in order to prosper from this kind of growth, you can invest in the index-linked stock, right? You can actually buy those big cap stock and keep over time, probably 15 years. But of course, because it's investment, you talk about 10 years, 15 years, 20 years, that kind of thing. You can buy the stock and keep because you will receive dividend as well. Or you can invest in FKLI. Okay, you can actually treat buying FKLI index as buying and 30 stocks or big cap stocks in the market. And of course, there was a saying that if you buy futures, you don't get the dividend paid to the shareholder. Well, actually, if you buy an FKLI and you keep for probably 10 years, every month you do a rollover. During the rollover, the market actually will give you a discount or give you some advantage during rollover, which is actually equivalent to the dividend paid to the shareholder. So actually, if you do it properly and you do the calculation a bit, you actually will also receive some kind of dividend by FKLI as well. But I'm not going to talk about so much here. Probably we can explain a bit in the Q&A.
Yeah, that's called a backwardation, right?
Yeah. That's during the spread and rollover. That's what happens actually. Yeah. So on the Dow Jones side, I just want to show you this chart is actually from 1976. Okay, it grew over time. That time was the the lowest point was 730. Imagine that Dow Jones was at 730 at, probably about 40 years ago, but now it grows to 20,000. If you own one contract, let's say for example, hypothetically you own Dow Jones stocks or Dow Jones index, and you keep it now, it's actually from 3 digits to 5 digits. So this is what the potential. Of course, there's some up and downs you can see in the chart, but I will explain a bit later on. Okay, now FKLI has got lesser history. Okay, we created this index, I think, during the early 90s. So these are the overall performance of the FKLI. So it grows over time as well. Okay, but of course it's not smooth. It go up a bit and then down because of crisis, because of the last time the subprime, then 911, and before that will be the 97 Asia economic turmoil and all these. Those things actually affect the stock markets. Not only affecting the FKLI index, it's actually affecting the overall market, which is the cash market or the stock market. That's why the index actually fell. The cash or KLCI fell, and the FKLI because tracking the cash market. So the FKLI also fell at that point. So it's not a smooth ride. Okay, you invest in stocks or any index-linked stocks, it not be very smooth. Anything actually is not going to be smooth, and there are some short-term uncertainties like recently Brexit, and then early this year US president election, war, and crude oil prices and all these things. So, but you can actually, let's say if you're investing in a stock alone, you can use FKLI also as to protect or hedge these kind of uncertainties by trading futures. Okay, now why or how to hedge? Okay, to protect this short-term risk, even though the index actually go up over time, it went up, but then there's some fluctuation along the way. Okay, so you can see that this is major down drawdowns from the market. Okay, these are the part that you actually lose money by owning stocks. Okay, but can you hedge your position by doing this? So of course, most of us has got the biggest asset in ringgit. Okay, 2 years ago, 2 years ago, ringgit actually fell against the US dollar. So, but because we don't have any, futures, or forex for onshore, we need to hedge. So can you hedge? You can, you look at like US dollar, we actually depreciated 10% during this period of time. But if you look closely on the gold futures traded in Bursa Malaysia, they actually appreciated 10% as well. So that means if ringgit fell 10%, the FGLD, which is the gold futures, actually raised 10%. Even though the COMEX gold is only up by 1.5. So if you buy along an FGLD contract, you can actually hedge your ringgit. So by hedging, by doing spread trading, by doing arbitraging, is all these trading methods used by traders. This probably you have time, you could actually search and read something about this. So actually, after you decide invest, you can actually do hedging, which is what we are doing in this slide. Okay, hedging is actually very important to protect position if you help against this short-term volatility. So if your investment is in stocks or securities, when the market actually downturn, you can protect by short selling the futures index. In this case, if you trade stocks, FKLI is your futures index. So how it works, let's say for example, as we mentioned before, let's say 1,800, okay, the value is actually 90,000. So if you're holding the stocks, okay, or securities worth about 90,000, you actually, of course, the stock should be actually has positive correlationship with the FPI KLCI. You could actually hedge these stocks with one contract of FPI. You just short it, okay? By hedging, you enter into the opposite direction, which means it's short position. So let's get back to the same chart, okay? During the market down, what you can do is you sell the contract and buy back when the market actually subsided, or actually stabilized. This is how you actually hedge your position. So that if you keep the stock from the beginning to end, you actually gain the whole long-term growth. But during the short-term volatility or short-term uncertainties, you short the FKLI so that you can protect it. The money that you lose from stock market will be actually covered or made back from futures. Probably not 100%, but at least over the long run, you actually still pretty much protected, and you probably don't lose during the short-term uncertainties. Now, there's a term that you probably overheard just now. What I'm saying is, in futures trading, when we say conventional buyer, we use the term called long. Or long and buy actually is the same term when you use in futures. So you can call your broker and say, I want to long a contract, or I want to buy a contract. It's essentially the same thing. And opposite to the long or short, okay, buyer is actually a short, often used for sell. That means you can actually call a short contract or you call a sell contract. It's referring to sell a contract of futures. And beside this, just briefly talk about arbitraging, and hedging. You can actually hedge FKI, against a lot of things like, FKLI against stock portfolio, which is your cash market, or any foreign index. There's a lot of traders actually trading this kind of method. That means they're probably buying FKLI, which is Malaysian's future index, and then they sell, let's say Simski, which is Singapore index, or they sell Japan Nikkei index and all this. So these are the arbitraging trading done by traders. So this you could actually probably have some finger as well when you talk about trading, right? And you can also hedge, let's say FGLD using ringgit, as I just discussed just now. It means when ringgit tumble, you can actually try to buy or long FGLD contract, which you can actually protect your asset. And you can also hedge with FKLI to neutralize any downturns or overseas market effect. Let's say if you're buying some stock, you're holding substantial stocks, probably around 9,000, as I just mentioned, you can always sell FKLI if you see the market actually going up, right? And you can hedge with other contracts month to create a calendar spread. This is the idea that we couldn't cover today, but you could actually think about it, because besides the FKLI, the favorite contract traded by traders are actually calendar spread. It means you can buy, let's say, a near month contract and then sell a 5-month contract, and vice versa. You can sell a near month contract and buy a 5-month contract. So this we categorize in so-called calendar spread contracts. Okay. Now,
yeah, and
before that,
CT Yong is one of the excellent spread traders in the market, a very well respected trader in spread trading. Okay.
That's what we do. What I do during daytime when we do full-time trading. Usually, a lot of traders actually are trading the spread. So I'm going to talk about this just a bit. Like if you start trading FKLI, like what I did. I started trading stocks, and then after a while, most of the traders will go to FKLI because essentially it's something that you wanted to do it, when you're trading stocks, because you trade stocks for the 5 years bull market, everybody make money, okay, and then probably bad time comes, okay, you can't make money or lose some money in stock markets, so you start look at the futures index is something that you can short. Over time people can short this, but you start to find how to do it, okay? And then, so that's why the FKLI, that contract that you just aware, we call it outright contract. Why you call it outright contract? Because it's a directional. If you trade with direction, that means you buy or you long, hoping that the price will go up, after this, or you short selling because you want to protect your stock markets or your cash market, then you want it to go down, okay? This we call directional. That means you have a direction in your mind. Or second, like what I just discussed just now, you can make it as an investment. That means you just long or buy this FKI for a very, very long time. So you make it like an investment. to buy these 30 top stocks, okay? And the good thing about buying FKLI is that you don't care which counter is the biggest cap in Malaysia, because they will do the adjustment and they will keep the market cap grow all the time. So that's why it is a good investment in long term, okay? And then as hedging, if the price, let's say you're holding a lot of stocks, you need something to sell or short selling to protect your position on your cash market or stock markets. So what you do is just short selling, which is we call hedging. Of course, you can do pure speculation. Speculation is like you just speculate. You think that market go up. You feel like the market won't go down. That's why you go up. Or you use technical charting. You use elevate theories, Fibonacci. You can use various methods to speculate where the market may go. Right. So this is one of the way you can do. Or election probably is coming, so you also speculate whether the market can jump up or get down. And vice versa. Right. So, but looking at FKLI, you cannot discount there's another part of FKLI. If you look at your quote screen in your trading platform from your broker, there's another on the FKLI part we call KLCI, which is the options market for the FKLI. That means, you see, the KLCI derived FKLI, and then FKLI derived options, so you can actually trade with options as well in Malaysian market. So of course, again, because option is directional in nature, you trade direction and you can do hedging. Let's say if you buy a FKLI, but the FKLI go down, so what you can do, you can buy a put. So it becomes a hedging position. You can protect your RX position, which means by doing a call put position. Also, you can do a strategy by doing, trading the volatility, the wicks, the alpha, the beta, the theta. I'm not an expert in this area, but I know people actually trading on this area. And then lastly, I trade more on spread. This is what I meant. I started trade spreads with FKLI spreads. So spread are actually used for rollover. That means when you want a contract, let's say if you really take this idea to invest in FKLI, let's say for example, when you buy a contract and then you want to go to next month because it's expiring this month, what you do is you use a spread market to do a rollover. So how to roll? Okay, usually for a long position, you just do a short spread. That means you sell near and buy far, so that you keep on doing a long far kind of action and close your near month contracts. So your position will be roll over almost forever until you satisfy and you close the position. Of course, you can also speculate and you can also do some trading with the spread contracts. Okay, there's a lot of traders will trade beside you, and then you can do a outright protection, because let's say for example, I know some of the traders out there, let's say they long a contract, which they need 4,000 to keep this contract overnight, but they have long pen contracts. But in order to keep this contract, what they do is actually they sell 10 contracts on the different month. Let's say they buy 10 contract on October and they sell 10 contract in November. Okay, by doing this, the exchange actually recognize you're doing a spread. Your margin will be lower. That means you can actually keep more contracts overnight compared to our position. So that's how you actually could discover. The FKLI can be traded, because it's a futures market, it can be traded various of ways, which only your imagination is the limit. All right. And okay, on the next slide, because I just probably roughly give you some finger on the FKLI, because it tracks the FKLI, FBM KLCI or just KLCI. Okay, and it never goes zero. So if it never goes zero, so there is actually some protection. So as long as you don't over leverage your position, that means you put in more margin than the minimum bear margin, that 4,000 that because margin is something that we're going to discuss in the next few seminar. Margin is something that it saves you and it also can hurt you. So if you control the margin nicely, so this is the part that nice, because you don't have to put up all the money to own these top 30 shares. But if you over trade or over leverage your position, so it become a double whammy, which because of the leverage, it kills you. So that's why you have to really control on this part. And FKLI is actually investable. You see, of course, people say FKLI is actually speculation, pure trading. My idea of FKLI is that you can actually invest if you look at the whole FKLI as the top 30 stocks from Malaysia. So that become a stock investment. But provided you put in 90,000 or equivalent value of the cash market, as in now, for every single contract you trade. So this, you make the FKLI become a investable tools, okay? And you can use it as an ETF or portfolio in one of your share market or your overall portfolio view. Okay, and then FKLI actually you can use it for pure speculation, which if you just speculate simply, okay. But I strongly recommend not to simply speculate if you don't know what you're doing. Okay, you can do hedging as well, because hedging is actually why the whole thing is actually created in the first place. Now, you understand the potential. You know what FKLI can be done. Of course, this briefly 60 minutes probably I can't say from A to Z, but this is the idea for you to discover. FKLI has got a lot of potential. You can create for speculation. You can create for investment. You know, you do it for your own so-called goods. Okay. You know the contract. Okay, there's a contract specification that you have to roughly know the idea. I simplify and sum up for you. You can actually use it as investment and trading, but these two things actually involve some risk. So in order to make money in long term in trading, okay, or invest, okay, you have to control the risk, which is from me is the key to success. Now, I always say that the hardest thing in trading is that you control the risk. You use position sizings. You use various methods to control your risk exposed every trade. But the person next to you probably know nothing or do nothing about risk management, but he or she could have made more money than how you actually control the risk and your result is. But that doesn't mean that you should actually try all the different methods which you forget about risk management. So I end this, probably I hope you all can do well by imposing, or using all these ideas that I just throw to you. And probably after this, I'll pass back to Chusen, then we can have some Q&A session after this. Chusen?
Yes, perfect. All right. Thank you so much, Cici. I think your training today and sharing today is really exceptional, and I think I personally also learned a lot and some gain a better clarity of how I can go about doing FKLI. And now we are opening it for Q&A. So in the meantime, I'm taking back the control. Okay, so can you all see my screen now? Cici, can you see my screen now?
Yeah.
It's my screen, right? All right, cool. So I think if any questions can write in the question panel, and then we will do our best to answer as many as we can in the next half an hour. All right. So the first question that we have from the audience is that is it the longest contract we can have is only 1 month?
The spot month contract is actually from first day or day one, you can hold for 1 month, the spot month contract. But the next month contract, which means is actually November. November started, let's say this month, and then next month, the November becomes spot month. So you can actually trade from the first day of October to the last day of November, which is 2 months. So almost usually the contract can be traded 2 months before it expires. Usually it's 2 months, but for those FAR contracts, the quarterly one, you can actually trade up to, some are 6 months, some are 3 months.
Okay, so the next question is on rollover. Now, so rollover means you sold the old future and buy the new future. That means you show the near month one, you sold the near month one, and then long the farm one, okay? So the question is that what will happen when you try to sell the this month one, but no one buy your futures that is going to expire? Will the bank buy it? That's the question.
Oh, okay. Okay. When you roll over by sell the near and buy far, meaning to say you are actually holding a long position. Okay. Let's say if you park a price at certain level, which no one actually take your position, want to buy at this price and sell the other price to you. All right. What will happen is your contract holding is long. Okay. You buy a FKLI, and then because no one take your contract and the market closed for the last day, last session, and you go into a process called settlement. So once the settlement is there, okay, your position will be evaluated by calculating the settlement value. The settlement value is actually calculated by Bursa. So the value is actually very close to the KLCI closing. So if your price, actually you buy a contract, if the settlement price is above your purchase price, the price that you go in, you make money. They will actually credit back the money that you make into your account. But your price is actually higher than the settlement price, and you do a long position. So what they do is actually they deduct the amount. Let's say if you lost 2 points, which is 4 ticks, 4 half points. So you actually lost 100 ringgit. So what they do, they will actually deduct 100 ringgit from your account. I'm not sure about the what broker, but usually most broker will not charge you full commission if you go into final settlement. So you may or may not need to pay the full commission or brokerage for full. That means you pay brokerage or commission when you go in the position, but if you go into settlement, you may not need to pay the full comp. So you actually have some slight advantage if the price favor you lah. So after this process, okay, then if you still want to hold a long contract, because you'll be forced liquidated by the so-called Bursa Malaysia or the clearing house, okay, then your position closed. So that means your position will be closed even you don't do anything. So it's actually safe. But then of course, if you make money, you gain up. If you lose money, you still have to actually lose money. It doesn't mean that nobody take my position, then that means I don't have to settle. You see, because whenever you buy or sell a contract, there's a counterparty with you. That person will be forced into a settlement as well together with you. So of course, after this process, if you still want to buy FKLI, you can just buy the next contract the next open day. Let's say, for example, last day of October, you didn't close your October, or for whatever reason you forgot to roll over because you're overseas. You just let it settle, and then you buy back the contract on the first day of November of the spot month contract, which is November already. So that way, actually, you still roll to next month, but just do it like in 1 day gap. It doesn't matter. It actually still hold the same value, provided from the last day of October to the first day of November, the price doesn't move quite a lot. Then you actually still very safe to roll the position. I hope that answer lah.
Okay, so thank you very much. Now the next question is on I need more of your clarity on daily price limits of 20% per trading session. Can you explain that a little bit?
Okay, you see, even though FKLI is actually tracking KLCI, that means, but it's only tracked because the contract says that on the last final settlement price, this FKLI will close or will use the KLCI last price as settlement value, right? So, but it only said the last day of the contract. But before the last day of the contract or before the settlement process, the price can go any direction they want. The price can be 10 points higher or can be 10 points lower or even more. So the session limit means by 20%, you can't go over the 20%. If you go over, the market will stop at there. It doesn't allow the future to deviate too much from the original underlying asset. It means you can't simply go and buy or sell a lot of contracts to push the FKL value beyond 20% mark of the cash market. And that is why they set the 20% limit. But the 20% limit doesn't mean doesn't actually, I don't think it's set to prevent this actually happen. Like let's say someone, to purposely control market. This to avoid some computer glitch or global meltdown or whatever reason to prevent this from happening, so that it can actually trigger all the stop orders or margin calls for every single one. So this is a prevention. But if you plan to do it, I would say no also, because you'll be facing a lot of just now I did mention about arbitraging, right? So the arbitragers will come in and let's say you sell the contract 20% over, away from the original price. I also will buy from you. Let's say if you sell up, because if I buy from you, if the market rebounded back to the 20% that you push away, I make 20% from you. Or if you're right, the cash market did collapse and track back the futures that you actually predicted correctly, 20% down. So what I do is just sell the stock. So when I sell a stock, I still make back. Of course, I can't short selling a stock, right? So what I can do is I give you something. I can sell a different contract, right? I can sell the next month contract. I can sell the next quarter contract. So that I still probably protected. And so overall, individuals usually don't do this, and I discourage to do it, because usually arbitrager will make you lose money basically.
Yeah, but arbitrage already mean it's zero risk already. Yeah. Anyway, so the next question is, what is +1 value after 5 p.m.? I think that's in reference to one of the slides that you mentioned earlier.
Yeah, there's a one actually to be fair, very detailed. I don't really look at the +1 part. There's a price that after 5 there's a one price. They just add in one more value to do the average. But to be honest with you, this one I really cannot say I understand totally on the calculation. But I did some calculation before. What I do is I just average down the last 345 to 445, the average price, and then after that I just minus out the highest and the lowest. Even you don't do that, because usually the final day of settlement, the price won't move a lot. Usually won't move a lot. So the FKLI will just track the KLCI. Wherever the KLCI goes, it just settle there. It just follow. And then in fact, most of the traders, the outright traders, the directional traders, they will actually simply just jump to the next one already. They will start trading. Let's say, for example, if today is the second or the last day of October, they'll just trade November. They will just ignore the October. So usually, I would say it wouldn't really matter if you're trading FKLI. The last +1 thing shouldn't be. But I couldn't answer 100% on this part. But also, I want to highlight is that usually those roll over to the next month, they will do it during the last week of the month. That means they wouldn't keep the contract to the last day. They will start roll over on the whole week of the last month, last week of the month. So they'll do it probably 4 or 5 days, and they roll all the price over. So if you want to do a rollover, so usually the last week of a month is the best time for you to do, but not the last moment of the day. Okay.
Okay, yeah. So it's good. Something just will get really technical, huh? But anyway, the next question is, I think just now you mentioned about the dividend. In a stock you have dividend, but in future you don't have dividend. But then when you roll over, there would be some benefit, right? So the question is on, can you explain more about the benefit, which is like, I think the backwardation and the contango.
So whenever there is a dividend payout in all these stocks, usually every quarter or every 6 months, during the rollover, the next contract of KLCI will be traded at discount. The price will be actually lower. So that means if you sell your contract of the near month's expiring contract, and then you buy the deferred month, which is the next month contract, usually at a slightly discount price. And that discount is almost the value of the dividend that you will receive. Let's say if you're going to receive, say 100 ringgit for the dividend, so roughly you actually can buy the price about 2 points actually lower in the next month. So that's what I mean. But it's not 100% guarantee, but there is a value there. In fact, there's some traders actually trade this kind of benefit. So during rollover, the FKLI is automatically in that way. It's actually the next one on a discount. So the price will be cheaper. Why cheaper? Because I only willing to buy the FKLI if the price is lower, because I'm anticipating even the KLCI Index or the stocks will be adjusting the so-called dividend adjuster, ex-dividend to that price as well. So that's why I'm anticipating the KLCI the cash market KLCI will be going to slightly adjusted at the lower level. So as a FKI trader, I will only willing to buy at slightly lower price, so that if you roll over, you should be able to roll with some kind of benefit at this. Yes.
Okay, so the next question is there any books or learning materials on futures trading in Malaysia that they can read?
Futures trading for Malaysian market alone, I'm not sure there's a book that really you can find. Of course, if you're trading FKLI, let's say for example, just pure technical, pure directional, pure speculation, usually you will need technical knowledge. That means price, you're trading with the price action, you're trading with the indicator, candlestick, and all this. Just a general. Now you don't even need a book. Probably you can just go Investopedia. You can just go any website. You can learn pretty well on this. But my opinion is that actually a lot of traders, we don't really trade the direction alone. We trade a lot of things that let's say option spreads, or arbitrage. So we are doing something that, because directional, you could be wrong most of the time. If you correct, okay, to trade FKLI directionals, let's say 60 of the times is correct, then you can make billions of dollars. So which almost impossible. Any traders, it's not easy to predict the trend. You know why? Because if you have a position held, let's say you buy FKLI, your mind want you to think that the market will go up. So you're actually in a bias. So if you have position trading in holding a position, usually you don't have a very correct forecast. So to overcome this, we try to minimize predicting the market. So I would say, besides technical, read some books, but I'll recommend you to probably focus more on the risk management side and how to manage a losing position. Of course, you can try the spread trading as well, because spread trading is actually very active in Malaysia, but it has been a best kept secret for probably 30 years already. So yeah, that's another part that probably you can dig on it. But I don't see any book out there teaching how to do a spread. Yeah, probably you really have to find out how to do spreads, how to do arbitraging, how to do a pay trading, how to do hedge, rather than just speculate via just pure technical, just pure any theory. It could work for short term, but it may not work for long term.
Okay.
But the most important part is always the risk management. I always mention that.
Yeah, that's very important, huh? But if I may add on, if you have followed our previous webinar series, our previous speaker Chong Ting Ting, she published a book on jumpstart in stock and futures trading, and there's I think a beginner guide to futures trading, and if you are keen, you can buy that at the bookstores. All right. So
Okay.
the next question is, can you compare the pro and the cons of investing in ETF equity fund versus futures equity index?
It's
a good question.
All right. Yeah, very good question and very tough to answer also. ETF probably because ETF is a fund, itself, and the fund actually has got a fund manager, and this fund manager will trade stocks based on his own discretionary. So he will buy or sell or own stock or even own cash with his own discretionary method or analysis. So if you're doing that, that means you're investing in the fund manager. So the fund manager will control the asset and buy, sell accordingly, and list this fund in exchange. Okay, so basically you're investing on the skill of the fund manager, which is good because some fund manager just simply buy the index stocks. Which, let's say if you are a fund manager, you just buy all the 30 stocks, top taps in Malaysia. Your ETF will be essentially same as the buying the KLCI. Okay, but that require quite a big sum of money because you simply just kind of buy a fraction of stocks and keep over time. And buying an ETF, you have costs incurred. Buying the ETF itself, there's a brokerage you have to pay, so that's a disadvantage. And then but of course, you're buying anything also, you pay the brokerage. Okay, now then the fund manager will charge you a fee, the trustee will charge you a fee, and then the fund manager buying all these stocks, they are actually also charged by broker, and the broker will charge commission to them. And often or not, because of funds, they're actually always a prime broker. Prime broker doesn't mean that you are treated prime as in very good. Yeah, you treated prime because you are actually charging at the premium also lah. Okay, so this is some disadvantages. And then when the fund make money, the fund manager get a cut. Okay, so they will probably enjoy some incentive from you, from the fund, basically. Now, investing in FKLI, if you have an investment mindset, as I suggested, so which I'm very actually pro on this, is that you only pay the minimum brokerage, which is you buy and sell a contract, right? You buy a contract, you hold, but when you roll, you buy and sell, so you actually pay the commission as well, and that's all. And then when you buy the FKLI, what you are actually investing is you're not if you're investing, if you use let's say full margin or half margin, you're investing. What you invested, you're investing on the top 30 companies, and these CEOs, these CCO, these CFO, they are actually working for you, and all 30 of them are working for you. So having said that, isn't a brilliant idea? I mean, instead of hire a fund manager and they acquire stocks based on their preference and discretionary method to invest, but buying FKLI, effectively you controlling top 30 company in Malaysia, and all the CEO are working for you. So I think it's pretty much a good pro. And the cost or the minimum cost to hold this contract, it's just the brokerage, and of course the margin that you need to top up, to pay . But of course, you see, if every month roll over, of course you have some incur some charges, right? But you can trade every quarter, right? So instead of trading every month, the spot month, you can trade the first quarter, the second quarter. So if you trade the second quarter, every year you only probably need to roll over twice only. So you only pay the twice, every year for the commission. So which is, I think, is a fraction of a cost to own this so-called asset. If any fund managers, any fund, at least the yearly fees is 1%, 1.5%, 1.9%. The incentive is ranging about 20% charging you, and plus all the costs. So yeah, I think the pros, if you really has an investment side mindset, investing in FKLI is actually a good idea, low cost. very easily, liquidity is there. ETF, if you buy a wrong ETF, no liquidity, or somehow the ETF doesn't work for whatever reason, so you still actually has a risk of facing losing over time. As I said just now, in US, mid-size cap funds, it was beaten by just the index itself. 95% of the time, for the past 15 years, the Dow Jones Index actually beat the mid-cap funds in US, which is very alarming actually. So yeah, this is the pros and cons I can think of.
Yeah, awesome. So the next question is on what is the pro and con trading futures comparing structured warrant in KLCI?
Okay. Okay. A disclaimer from me. I was trading stocks. I stopped trading stock. I trade most BMD's futures nowadays. So basically, I'm a full-time futures trader. So my answer or my opinion may be biased. Structured warrant. Structured warrant will be, there's a lot of limitation actually in structured warrant. And then whenever you buy a warrant, you actually pay a premium, and the premium is actually very, very high. That means you don't own the asset cheap, you own the asset expensive. You buy almost like 100% premium or 30% premium. But buying a futures, you buy at almost net cash value now. Let's say if you buy FKLI now at this price, it's almost is the value or even under value or below value of the stocks that you're acquiring. But buying a call warrant, structure warrant, any warrant, you buy a premium. Unless you actually buy when the market crash, the mother crash, so that the structure warrant also crash. So a lot of layers has been inserted in the structure warrant. So you actually don't really enjoy the benefit. You only make, because the underlying asset went up and you went in the warrant at a very cheap price. So you actually doing what I call is speculation, super speculation, of course, aka gambling lah. So, but trading a futures, you always trade the value of the asset as in now. And then when anything goes wrong, let's say your decision is actually wrong, you can always probably buy a call, buy a put. You can even do an opposite trades, which turns to a spreads, or you can even arbitrage or do a, let's say, hedging on the, let's say, Singapore, Japan, Hong Kong index, just to protect your position. Or you can even actually, let's say you sell a FKLI, but price doesn't go down. Instead, it went up. So what you do is just buy stock lah. So you see, you can has so various way to protect your so-called asset we call managing a losing position. But buying a structured warrant, buying stocks is one directional. So that means you can only buy and you make money when the asset go up. You can't actually really manage your position, except what you do is that you buy stocks and the price go down, cut loss. You can't buy Maybank and the Maybank price go down and you went and sell public bank. It doesn't work in Malaysia. I mean, you can short sell somehow, but it's not that direct. But you can buy Maybank and Maybank price go down, you short FKLI, most likely you can save your asset from losing. So at that context, I would say that is the advantage if you trade futures, because it's direct, it's well defined. As long as you know it's actually leverage, then you are actually fine. To trade warrant, you have to know the premium, you have to know all this inside out, how they do the settlement and all this. Really, everybody gets game, So I hope the answer.
Yeah, so the next question is on how do we take advantage of the premiums or gaps between the cash market and the future market?
Right. Okay. There's sometimes there's a saying that, let's say, if the cash market is higher than futures, so that futures eventually will follow. That's only true when is about to expire. So the futures will actually go back to the cash market. Let's say, for example, the last week of the month. But sometimes when the sentiment is bad, so the futures will go down faster than KLCI. So let's say, for example, US dropped 2% overnight. So market open at 9. But before 9, a lot of people are selling FKLI already. So FKLI will be trading at a discount because the price will go down. FKLI will be open, like, let's say, 10 points below yesterday closing. Okay, so effectively, if KLCI will be open at the same level, then it's actually FKLI is actually on discount. So either FKLI will go up or the share market can come down. But it can just stay, let's say, 10 points premium or discount for the next 2 weeks until settlement. So how to trade this? I'm not an expert in trading this. It gives you a thinker or idea. Usually, because I'm a spread trader, so I also think from the angle of arbitraging. So one of the assets is actually wrong. One of the instruments is wrong. Either KLCI cash is wrong or FKLI is wrong, but you wouldn't know which one is wrong. So in order to make money from this kind of trade, any arbitrager, any spread trading traders will be, you buy the undervalued asset and you sell the overvalued asset. So you sell the one that high and you buy the one is actually lower. But often or not, the price will actually keep on widen. The spread become widen. So and then you have to do average down. So, but I'm not very sure there's a way for you to do in FKLI, because FKLI you can buy and sell, but the problem is that you cannot buy and sell KLCI. You can only buy and sell so-called the stocks, the 30 stocks, but you have to combine all the 30 stocks will be very, very messy. So I will actually slightly recommend, if you think of doing something like this, what you can do is you buy a near month, which is, or you sell a near month, okay, because it's discount. Let's say FKLI is discount. You sell a near month and you buy a far month, so that you hope that the far month represent the futures, which is FKLI already, which is next month, and the near month is closer to the settlement or closer to the expiration. So it will actually mimic or close to the cash market. So then you sell near, you buy a far, hoping that once everything converges, you can make some money from this trade. This is how I would think. Okay, I will not think that if FKLI below KLCI should the FKLI should rebound back to KLCI, or if FKLI is below KLCI, means that the FKLI can go worsen to it, because it's always 50% chance. I wouldn't make a we call outright trade like this. I'll only do a trade. Probably I will sell in October and buy November.
Okay, well, we have come to about 10 o'clock, so let's just do one last question, okay? And yeah, I think today I still have like 10 to 20 questions on my screen. So this is how
I don't mind taking a few more actually.
Yeah, this is how active this is. So, but the last question is, when we do start trading investment, we use FA and TA. So what can we do for futures? What indicator do we use? Should we more FA? Should we more TA?
Okay. To answer this, also I have to disclaim, because I don't trade the outright direction of any asset. For me, trading any directional is actually a guesswork. It's always a 50% chance. You may have a better chance of success, let's say 65%, which is very good. Then you have to employ a lot of position sizings and all the expectancy testing. Okay. FKLI is essentially the KLCI because of the settlement price. So if you are good in fundamental, you know the country economy, GDP, you know elections, you know all this, you can use the fundamental. You know the top 30 companies are doing well in their latest quarter. You can just long FKLI. Fundamental works I'm actually trading with fundamentals quite a lot. Okay. Second thing is that if you're very good in technical works in FKLI as well, but technical or so-called forecasts or signals to me is actually probably weighted about 30% of your the chance of making money. The rest of the chance, 70%, is how you do when you lose money. What you do actually when you lose money, or how you manage to minimize the money that you're going to lose when you are wrong. So which 70% actually at that category. If you still look for a signal, indicator, or any method, technical fundamental that can be 100% correct or correct most of the time to let you or allow you to be successfully trading or investing in long run, then probably you still miss the biggest direction of trading to be actually trading for a living. So I would say look beyond this barrier, and then you should find that, let's say for example, what I'm doing is I don't really the overall direction of the underlying asset doesn't matter me quite a bit. I'm more on looking at the rational, whether the price go up, is it rational? If it's not rational, then I will sell. If the price go up because of obvious reason, I'll actually buy. So my trading probably a bit different from conventional method of trading. I don't want a 75%, 85% accurate signal, because any signal that you look at with a high percentage, it probably is actually curve fitting. So, and then if you use your eye to skim through the charts and all this to get a confirmation signal on what indicator to use, then you'll come into a trap we call confirmation bias. So avoid this kind of common mistakes. Then you should be able to probably trade better. Well, after saying this, what is the method, right? So after saying this, the most important part or the missing link is that not look at the signal, not look at how accurate I can predict the future. No one can actually predict the price correctly. I'll say no one, even though you can see some example probably in the net, they can and they could, but most probably they can predict or forecast the market correctly because they're not trading. Because if you're trading, your mind is actually biased to your position, so you can't actually guess it correctly for long run. So in order to minimize this kind of hacks, if you either do testing, okay. The reason I'm saying this is because I'm actually reading chart. I'm doing all this kind of thing for the past like 20 years. Not all the method works in long run. It could work for probably a few months, 1 year, 2 years, but it doesn't work for long run. And then recently, because all the algo computer trading, I've been using software to test all the signals. It comes up that from the naked eye, you can see the signal is actually correct. You can make money out of it, okay? But if you trade using a signal, it's not going to make money in long run. If I test using a software without thinking bias, confirmation bias and all this, it doesn't make money or make handsome money over a long period of time. So pretty much technical works, fundamental works, but it only helps you probably 30% maximum. It could be less than that if you're not very good in these two areas. What helps you to be able really trading is I did mention in this seminar is that the risk management part or the money management part is all you wanted to be successful in trading. And yeah, all the best.
Okay, excellent. We have come to the end of the webinar, the third webinar series, third webinar called Understanding KLCI Futures. So I think PC has poured his heart and soul to make sure that you understand what is FKLI. All right. So anyway, for the next session, we have topic on futures trading plan. Alright, so it will be on 26th October 2017, 8:30 to 10 o'clock. However, this session will not be done by CC, will be done by our another speaker, Ting Ting. So if you want to catch CC, you have to go to a November session. Alright, so the registration link is sent via the chat box. So if you want to register for the next one, you can go to our the chat box and you will see the link for the next sessions. Alright, so with that, I hope that we have come to the end of the webinar today. So I want to thank you for being a wonderful audience this evening, and I hope that you have a pleasant rest of the day. And thank you, CC, for spending your time with us this evening. Thank you so much.
Thank you. Thank you.
Alright, and goodbye, everybody.